based on our analysis, 4,200, 4,300, that could be the floor for gold. That doesn't change much for these stocks. You said that they had a record quarter. What was the average gold price of the last quarter? We're talking about like 4,100. So gold futures were now above 4,000 on the 200-day moving average. It would be about 4,400 in May. So it could get to 4,500 in May. When you get into June, that's going to be 45, 4,600. The moving average is going to catch up, and maybe it's 4,600. Maybe that's the next low, which is only, what, 10% below where we are now?
We know this. Somebody didn't let it go below 4,400.
Hello, everyone. Welcome back to our regular monthly chat with Vince Lanci. He is the adjunct professor of corporate finance at University of Connecticut, as well as the publisher and editor of the great Gold Fix on Substack. All you guys should be subscribing to that. And Vince, wow, a lot has happened since we talked about 3 weeks ago or so. The bombing in Iran looks like a war has started. I'm not a geopolitical expert, so I can't tell you much on any of those fronts. We're all about the markets here, but I and the listeners were all curious. What's your view on how this will impact precious metals, and specifically gold?
I think, yeah, I mean, that's what we're all asking now. I mean, is this all about oil or does gold participate? And the answer is, having been a veteran of 3 wars during trading, the first 2 Iraq wars, every other false alarm that amounts to like almost a war. This is shaping up to be like Gulf War III. I would say the thing about gold is when you're faced with a situation like this, it's probably best to go statistical, to not have a feel for it or be intuitive. And statistically speaking, my dog is going to start barking. Statistically speaking, gold is wildly inconsistent in the first 90 days of a war. Okay. And it's also wildly consistent in the next 90 days of a war. So when a war starts in the first 90 days, should I bring that chart up?
Yeah, absolutely. Yeah. I'm writing this down. This is important.
All right. So for the first 90 days of a war, the gold market, there's 2 columns with red arrows on the screen right now. The first column is gold and the second column is oil. Now, what you'll see is at the bottom where it says the median of gold up 30 days after 3 months, 90 days is up 6%. That's the median. The median for gold up after 6 months is 18.9%. Gold will be higher 6 months from now. Gold may be higher 3 months from now. That's really what has happened consistently for gold over the years, and not just forever, over the last 20 years as well too. So what you end up seeing that at the beginning, now if you look at the right-hand column, the second arrow, oil is up on average 18.5%. I'm sorry, that's the median, not the mean, 18.5%. But after 6 months, it's only up 0.3%. So when there's war with oil disruption, the first 3 months are all about oil. The next 6 months are all about gold. And I can say that from history because that's what happens. They basically get gold out of the headlines and then they work on getting oil out of the headlines and then they let gold go up. So as long as they don't want to see gold and oil rally at the same time. Look at the Israeli-Hamas war. Gold rallied 13% in 3 months and oil was down 7%. Okay. In the Russia-Ukraine war, gold was down 4.5%. That's because it was happening at the same time that we were raising rates, and oil was up 18%. That's the only aberration.
Now, context is really important.
Exactly, it is. The one that matters, the one that's most representative of everything, to be fair, is the Gulf War, the first Gulf War. In the first Gulf War, gold was nowhere for the first 90 days, and then it was down 4%. But oil was up 57% and then down 8%. So if you take the Gulf War, because it's a war where oil is going up, and then you combine it with the Iraqi war, gold's going to be up 6 months from now. I'm not worried about the next 90 days. I don't think it's going to be up for the next 90 days because look, when oil goes up, you have a stagflationary pulse. And when you have a stagflationary pulse, everything drops. Stocks drop, silver drops, gold drops. And then eventually they find their bottom and then they start to move higher in unison. But gold will lead the way because the Fed will probably have to cut rates. So I'm not wildly bullish about it. I'm going into this different than most people. My expectations for gold are to not go up during this time frame. My expectations for gold are to go up after 90 days. So that's where I am with that. I mean, exciting. It's not headline grabbing, but I'm comfortable with that. Right now, it's basically, I did a story 2 weeks ago, and the headline was "Trade Oil, Own Gold," and that's the idea right now. You want to be long oil as a trade, which is, it's too late. Oil's coming off as we speak, and you want to own gold because there's nothing. Look, this is about oil. This is about the Strait of Hormuz. Right now, let's just do the math here. The Strait of Hormuz is shut down effectively, and oil's not getting out. So the price of oil is close to $100. The price of food is going to go up because they can't get fertilizer. The price of oil is going to stay up. Stocks are going to stay down, and gold is going to go up because you're going to enter into a stagflationary environment. We're entering into a 77 environment. I'm not pounding the table on inflation tomorrow, but we are going to get an inflationary shock. Goldman Sachs said yesterday, or 2 days ago, they said with oil at $100, that puts inflation at 3%. Period. It just does. Okay. Now, can the Fed raise rates to fight that inflation? No,
No.
they can't. They're probably going to cut rates because of the credit problem. So I'm completely sanguine about the future for gold. I'm not worried about the next 90 days, though. I think we can go lower, but that's it. I have a couple other charts here we can get to as well if you want. It's up to you.
Well, I actually have three follow-ups, but two comments and one question. Well, the first comment would be this analysis here completely agrees with what I see technically, but we'll get to that a little bit later.
Right.
The follow-up question would be about oil, and I think you answered. So my question about oil, we had this pop, but selling off today, and that's the question: is this the start of a trending move higher in oil, or are they going to be able to knock it back down, or is it just going to hold around these levels and then kind of be a pain in the butt for a while?
The short answer is I think they're going to knock it back down. The Saudis are going to pump oil, and then it's going to stabilize at a higher baseline. To put a little more meat on it, I mean, it's hazardous to have a prediction on oil now, but there is a behavioral pattern that clicks in during war with oil. And the behavioral pattern is this: oil goes up, then the forces that matter will conspire to keep the price of oil down. Now, that'll either be SPR releases by the US, coordinated SPR releases with Europe, or the Saudis will pump more. Now, normally, I would say to you, cut and dry, I would say to you, oil is going to go back down and then it's going to baseline where it was. That's what I would say normally, because that's what's happened the last two times, except for the Israel-Hamas war took a little bit longer, but the Israel-Hamas war was going up for different reasons. So the Russia-Ukraine war is probably the best example I can give you. What's different is when there's a war in Lebanon or a war in Israel or a war in Syria, that's good for $10 pop in oil, and then it goes back down. But when the war is in the Strait, that means the Saudis can't pump. Now, the reason that oil should stay firm, I'm not saying it's going to, oil should stay firm, is because you now have an elevated risk of uncertainty in the Middle East. The U.S., whereas we used to be the cop that move your picture over there, where we used to be the cop that policed the unrest, now we're the instigators of unrest. So, if you look at that chart that I still have up there, in between the two red lines, that's Pax Americana. We're now outside the two red lines again, and now we're in an era where the U.S. is no longer keeping the peace, but the U.S. is making the war. So the Gulf War, first two Gulf Wars, we went in there and stopped aggression. The third one, different story. This is the third Gulf War. So I would say, to bring that home, I would say bullish oil now, bearish later, but not as convinced as I used to be. I used to say like, okay, if oil goes up to $100, it'll be back at $80 in 2 weeks, and then it'll be back at $60 in 2 weeks after that. But that's when we got along with the rest of the world. So I think it's going to baseline at $80 now. To have an opinion, it's easy to have an opinion about oil right now because everybody is. But I just want to be clear about it. They are working on getting the price of oil down, and in the past that's been easy for them because they work together. But we're no longer working as well with the rest of the world as we used to, and high oil prices is good for everyone except for the U.S. and China. So high oil prices is good for Russia. We're not anti-Russia anymore. High oil prices is good for India. Yeah, thank you. I should have taken that off. High oil prices is good for the BRICS, for the Saudis, and it's not good for China, and it's not good for the U.S. So really, it's a push in my opinion, and the added unrest is going to keep oil higher. So oil chronically higher at say $80 a barrel will give us gold at $6,000 an ounce in 6 to 8 months. That's not unreasonable to think. But tomorrow or the next 90 days, no idea.
Yeah, I do have a follow-up question about the impact on miners, but maybe we could go to the technicals first on gold. A couple of the
Oh,
charts,
the monthly chart?
the monthly,
Sure.
or even you can even pull up a daily first.
Okay. There's oil's daily.
It's funny, the oil chart kind of looks like gold did, before it had that peak.
It does. It does. Let's go back to it and let's say what we think, if we think anything. That looks like it's the beginning of the end for oil. If oil trades unchanged today, I mean, it looks like it already did.
Yeah,
Give me
can
one
you go
second.
back? Okay, go ahead.
Hourly? Should I pull up an hourly?
Well, after that, let's look at like a 20-year chart so we can see
Look
the
at that. It
historical
just traded. It
context.
just traded
Yeah.
to close the gap. It just traded to close the gap. All right, so we'll go monthly on the oil.
So the major resistance looks to be you have 110, I would probably say, then 120, obviously. But you can see how we've made a doji, and this is just the monthly.
Yeah, I'm showing you
look-
the monthly. I'm showing you the monthly for the futures now.
Yeah, so basically, oil futures here, if you're looking at where's the monthly resistance, 120. It's right around 120. So oil spiked all the way up into heavy resistance and heavy selling. So that
That's
would
right.
tell me, that would tell me moving forward, what could the new range be? I'm just guessing here, but what, 85 to 110 maybe? I'm just after looking at this for 10 seconds.
There you go.
Obviously,
So
you
there's
have 120,
your
right?
120, right? And if you want to just be fancy about it, here's oil. There's your range of oil, and there's your midpoint. So we just spent a decent amount of time ranging above, below, and now maybe we're going to be ranging above again. So maybe 72 to 90. Not bad. That's a good guess
Yeah.
on your part.
Yeah, 72 to 90, that would be kind of the realistic bearish view, whereas the bullish view would be, what, 80 to 110 maybe, or 80 to 120?
While the bullish view is more like, 80 to 150. You know what I mean? Like, because if you look at this as a breakout, you're like, oh, well, if it gets above that, it's going to go to 150. That's not going to happen. At least I don't think so. If it does happen, lock your kids up. They'll be in the draft. So, all right. Yeah. So that's oil. Should I get rid of these lines?
Well, yeah, I think we've covered it on oil. Let's go to gold now. And so, yeah, let's look at a daily chart on gold. Can you throw in the 200-day moving average?
I think so. I think that's 50.
Yeah, I think that's a 50.
There you go.
Now, this is a spot gold or futures?
It's spot. You want to put futures up? I can do that.
Okay. Well, yeah, thank you.
Same thing. Same thing.
Yeah, so gold futures were now above 4,000 on the 200-day moving average. Now, Vince, I've mentioned this on videos in the past. If you look at gold's history, I mean, it's kind of master of the obvious, but it makes a breakout, then it runs, then it's big correction to test the 200-day moving average. So that is something I'm focused on in my work. The
Right.
200-day moving average, you can see here, now it's gone above 4,000. It would be about 4,400 in May. So it could get to 4,500 in May.
Wait, let's do a little bit of art here. You ready? We'll go one. How's that?
Oh, that's beautiful.
That gives us, you're right, 4,400 in May. There's
And just
paper.
and just based on the price action, you could draw a horizontal line, maybe around 43.30. For me, if I'm zeroing in on one area, I think that's where you could have the strongest support. Yeah, or it
Right in
could be
here? In
4,400. Yeah,
here?
right in there, right in there. Yeah. But I'm looking at different charts, and that to me, I'm not saying it's going to test that and bottom it, but that's where I see the strongest support, 4,300, 4,400 with where the 200-day moving average could be.
Right,
Because that 200-day eventually, like if you get into, yeah, when you get into June, that's going to be 45, 4,600.
right.
So I would love to see gold test the 200-day moving average in the next 2-3 months or so. I mean, that to me would be, that's like our best buy opportunity in gold since,
You know,
whenever,
uh,
maybe 2 years ago.
you know, Jordan, if we go back, let me just pause these lines for a second here. If we go back, it wasn't too long ago. Whoop, I don't mean to do that. It wasn't too long ago that we had a 4-month sideways range. It was April of 25 to August of 25. See that? We could have one of these happen again, but lower. In other words, we can work our way to the 200-day moving average per your prediction. As the 200-day moving average moves up to meet it, and then the market could rally. Who knows? Maybe we could.
Yes, if we went sideways into the summer,
Right.
as I said, the moving average is going to catch up, and maybe it does. Maybe it's 4,600. Maybe that's the next low, which is only what 10% below where we are now.
Right. Right. And
So
that's where we were over here. We
I know
know this. We know this. Somebody didn't let it go below 4,400. And then they didn't let it go below 4,640. So this market should not get below your line here of 4,300. In fact, I'm gonna tweak it just for fun. I'm gonna tweak it and bring it up to here. Because that
yeah,
low, I mean, it's almost like what you have is you have a,
that's the beautiful line. I'm going to use that, by the way. That's connecting those 2 points.
you know what I'm looking at? I'm doing this. I'm saying this line, and now you have this range in here. This is an uncertain area, right? If it gets below here, basically, this is a line that I do. Actually, it's not a perfect line. It's not perfectly parallel. This is the line that I drew, but this is your line. So it's almost like it should not pass this line at all. If it gets past this line, then you know to buy it in this area here. Anyway, who knows? But it looks
But
pretty good.
I really like your line, by the way. That makes a lot more because you're connecting that peak there at the beginning to the intraday spike low that we got. So
Right, exactly.
it's not flat. It's like increasing slightly. So I'm usually not a fan of those types of lines, but that makes a lot of sense because you're connecting two very prominent. I mean, the two most prominent points in the
Yeah,
last
you're right.
6 months. And you just to repeat that, and you're right. I mean, gold doesn't have. I mean, it doesn't have to even test the 200-day moving average, but it could come down to 46, 4,500 again, and maybe it gets close in it, but it doesn't test it.
Oh, look at that. Jordan, if you put a high here, the high here and the high here gives you that range and gives you the bottom of that.
Yeah, that's
Well,
why
I see. So there you go. And if we, I'm sorry, I should do this. May comes in here. Your line crosses these two lines in May. So 4,400 is the intersection. So we shouldn't get below 4,400 between now and May. That's the answer. We should not get below 4,400 between now and May. Should I stop this? Or you want to go to silver?
yeah. Let's talk about silver.
Oh, that's right. The silver monthly is the one that looks bad. We want to do futures on silver, right?
Yeah, we can look at that first before we go to the daily. So that's what concerns me in silver, even though it's already come down quite a bit.
Yeah, but this kind of starting to look like a bear. I mean, you and I were joking before we started recording. You're like, the silver monthly looks bad, and I'm like, it doesn't really look that bad. I mean, but then you're like, well, it's only 1 week into March, so Yeah, you're right. It could be an ugly month. Who knows? Where to next?
Let's pull up the daily. So, yeah, the 200-day you can see there. It's at basically, I'll round up. It's at $55. So
Right.
same thing. Question is, draw a line there and see. Maybe you can see when that's going to get up to 65 or 70.
In May, May
67, I think we had it.
1st, May 1st, it hits,
65.
yeah, 64. Why, you drew one of those as well? 65, yeah. I mean,
Yeah, so not as good as yours.
65. Yeah, 65 in May. So basically, we want to survive above 65. There's your rhyme. We want to survive above 65 in silver until May. And we want to, I can't make a rhyme for gold. We want to stay above 4,400 until May for gold. Okay. So I'm going to put my buying shoes on between here and 65, which makes sense because silver went as low as 65 here, right? And in gold, we run into it over here. So yeah. All right. So we have a plan. The plan is don't be bullish until they have an intersection with the 200-day moving average, which, by the way, how many days is that from now? March, April, May, 90 days, which puts us into my 6-month time frame. Within 6 months, silver and gold would start to run again.
Just after the first 3 months.
After the first 3 months, exactly. So,
And that's why I was saying it aligns perfectly with my view.
imagine if we're right. We'll come back to this, tell everyone.
And corrections are a function of price and time. I think we need more for both, but there's also the time element. Vince, you know this. We had huge moves in gold and silver. I mean, really overbought. That's good. We're in a bull market, but
Yeah.
you need a rest period. I mean, so gold's had 3 major breakouts in its history. Of course, 1972 and then 2005. The one we had 24 months ago or 25 months ago. No, it was 24 months ago. That would be the second biggest breakout. If you look at number 1 and number 3, their first big correction lasted 5 months. Each lasted 5 months.
Right. We got to
So,
pull up one of your analog charts.
yeah, I'll put that up in the post-production.
Yeah. That's a good chart to put up.
But here's the thing. Give me your comment on this. So there's what I just mentioned, which 5 months. And remember, I said months ago we had to correct at least 20%. We corrected 21% in 3 days. Gold
We
did.
did. We did.
So it
A
already
little
achieved
fast,
that.
but yeah.
Now we just need to achieve the time component. But the average of those two moves on the same scale, Vince, it hits $7,000 an ounce 12 months from now.
Does it really?
Yeah. That's just the average of those two.
Right. 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 Yeah. So I like it. I like this. We're talking ourselves into getting long in 90 days. I like this. This makes a lot of sense. There you go. Let's see. How does that measure up with silver? So 65, 3 days. Did you do an analog? I shouldn't even be asking this question. I'm putting you on the spot. Have you done an analog for silver like the gold rallies? Like the gold bulls?
Yes, but I need to update it. The problem is for silver, it's more volatile. It's history.
Yeah, it's a definite,
it-
this is a definite different market.
It's not as clean of a history. And I almost think I need to do like a daily analog, which takes more time because silver it's such a huge move.
Right.
But what's interesting is silver, the breakout move that we had, it wasn't as big as the 2010 to 2011, that breakout and that move.
Right. Right. In terms of fierceness.
Yeah,
That's
the
right.
length and the magnitude.
Right. It wasn't it wasn't as violent as well. It actually was orderly for a good portion of it. It didn't get you a headline. $10 higher, it never caught a headline. Never caught a headline until $80.
Yes.
That's right.
So the silver history, it's more volatile, so it's more difficult to draw like a linear comparison, I would say.
Right. 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 You got to go long normal. Understood. You want to touch
go
on the
ahead.
miners chart?
Oh yeah, go ahead.
Pull
Yeah.
this up just pull the miners chart up for a second, and then we can talk technicals. Because I think no one, a lot of people are okay. So when oil spikes like it has, on the mining side, people start getting worried and start rubbing their hands about energy. They say, oh, energy costs are going to go up. Now, I'm not saying oil will not affect miners. I am saying that any effect that it has on miners will be exaggerated because it really shouldn't be that big. And here's what I mean. If you look at the two big arrows there, this is a chart from Zero Hedge, by the way. This is the oil term structure from spot all the way out to 2037. Now, we only care about this area in here. That's for the next 3 years. And what you'll find out is that this is where oil was a month ago, and this is where it is today. But that's spot. Look at how steep the curve is. So if you're a miner, just some math for people here. If you're a miner, oil went from $66 to $100, but you're not hedging on spot. You're hedging here. Oil went from $62 to $66. This market is not pricing in long-term. Now, it could change, but this is not necessarily a big problem I mean, how far out do miners hedge their energy costs, the bigger miners? Do you know?
I don't know, but also I will say it's not uniform the way energy works with miners because different countries, different jurisdictions, they all have different markets. So they might be buying their production. They may have already hedged it or they have it contracted for the next 12 or 24 months. So
Yeah, I gotta think the bigger guys have contracts or they're plugged into a grid.
yes, a lot of companies are doing that and also looking at that option for energy and power.
Yeah.
So
So
it's
I think
yeah, just to interject for one more moment, it's for the industry. Or what I mean is, it's not, as I said before, it's not uniform for every company. Like that's the
right,
issue. Every company, the energy situation is different, and so you have to look at it on a company by company basis. It's also why I think we're at the point in the cycle where you want to be more of a stock picker. Like at the beginning, when you're at the beginning of a bull market in miners,
right,
you can own everything. It performs really well. But that
right,
performance starts to tail off towards the end because you start to get oil goes up, cost inflation starts to become a problem. Then you're subjected to that. You're subjected to that when you buy the entire industry. So
right,
I am talking my own book here, but I'm just saying, I think in the second half of a bull market in miners, you want to be a stock picker. You want to have your own basket. In
right,
the first half, you can get away with that. And that's actually when the industry itself performs best because you don't have the cost inflation.
right,
So, however you look at it, cost inflation will start to be an issue in the next few years. However, the last thing I'll say is based on history, at the beginning of it, it's like a dent, it's not a headwind. But if we're sitting here talking, 3 years from now or 2 years from now, and oil's above 125, inflation's at 5%, gold's at 8,000, and we think gold can go to 10,000 or whatever.
right,
That's the point when it's too late for miners. Like they're not going to participate in the last third or the last quarter of the
right,
bull market in gold.
right, right, right.
So that's my spiel on miners
That's good. I
and
appreciate that.
energy.
That's helpful because I started looking at mining stocks. I picked up I have a list of juniors that I'm looking at now. I mean, I'm not going to discuss them except to say there's Artemis, there's West Redley, a lot of Canadian juniors that have limited resources, but good yields. So I think your M&A is going to start happening soon. Your mergers and acquisitions. It's
I think you're exactly right about that because let's think about it. These miners, the large miners, their stock prices are so strong. And as you've probably seen, I'm a bit more tapped into it. But in the last year, 18 months, stocks that have bought a gold mine, they've done really like fantastically well from that acquisition. That's completely different. 5, 10 years ago, it'd be the
right,
opposite. They bought something, oh, that was a good acquisition. The stock is down 10% the next day.
right, right.
Here, companies, even just a producing gold mine, nothing special, it's completely transformed a lot of companies massively.
Interesting. So there must have. So we need Apple to go out and buy a gold mine. That'll be cool.
It's probably one that's not big enough for them and their size. They could buy every mine probably.
They all could. That makes sense. So not only are the miners that are undervalued cheap, but the miners that are more properly valued have a lot of extra cash and they've been rewarded for buying other mines. So that's a green light to buy more miners. That's probably going to happen. I can see that. That makes sense. We want the technicals.
Okay, yeah, let's go.
I mean, we could. I mean, you have your GDX and you have your breakouts against your analog breakouts against the S&P 500, and that's actually good. Should I put that up?
Yeah, you could show gold against the S&P or GDX against the S&P.
Okay, so you're up.
Yeah, so we are weeks into a major breakout. Not only gold has broken out against a 12-year long base against the stock market, but you can see here as well, GDX, gold stocks, they've done the same thing. They're pulling back a bit, totally fine, totally normal, nothing to be concerned about.
Right.
But Vince, this is being driven by gold and gold stocks, their strength against tech stocks. So I think that's what's changed in the last couple of months. That's what could change moving forward, is you're seeing capital is now starting to rotate out of the Mag 7s into precious metals. The Mag 7s and also tech as well at large.
Which of these three lines do you care about the most in terms of the breaking out of the rounding bottom? This one, or that one?
I would say probably the middle one.
Okay.
If there's a way to do it, if you're looking at, that's good. And I would just say, if you're looking at, when you're ready, we can look at a daily. I think like that low, if you look
That
at a
makes
daily,
sense.
if you look at a daily, I'll point it out.
All right, hold on. It might get a little bit.
Okay, we don't have to just do like a daily 6 month or like a 1 year.
You mean like
Yeah, that's good. That's good.
that?
I think as long as it holds above, it's just a little bit lower than where the line is.
Right.
Yeah,
Right
like
here?
right there. Yeah, as long as it holds above that, I think it's good.
So basically this bottom and that top.
So I guess that was like the third line, basically, when you drew the 3 lines.
Hold on. Let's see what that looks like.
Yeah, I think those 2 lines, those are really good as far as support levels. But
Okay.
if you look at how strong, let's look at how strong the move has been. That could totally chop for 2, 3,
I
4
know.
months
See how it's
and
shopping around now?
and totally be fine. And that's the point I've been making in the last month or two, actually, is that we got a huge breakout, but it's been so strong that this thing is probably going to rest for a while, and then it's going to resume its uptrend after that.
Right. You have orderly, pull back, big chop. I think this market is kind of like giving birth to itself. It's about to actually hold on to its gains. There's a fight here. There's like, you know what this is? This is profit taking from all the people who've been holding on for years, combined with new entrants coming in. That's what that is.
Yeah, and maybe some of the hot money
Yeah,
that bought
exactly.
in the last month, like they're probably getting stopped out. Some of those guys are bailing for sure.
Yep. Hot money is selling the pullback. I believe that. So you have to hot money. It probably said, okay, we're above here. I'll sell some. And as it comes off the highs there, they're panicking. Yeah, sure. I'm with you on that. Looks good.
But
Yeah, I mean, it looks way better than the gold chart, when you think about it that way. It's actually a very pretty chart. I mean, it is the gold chart 3 years ago, in a sense that you remember how you were worried about the 64-40 portfolio for so long? Well, here it is. It's broken out against the 60-40 stock portfolio. So we're ready to go.
yeah, I mean, this is the last thing, is breaking out against the stock market. There's I don't know what like macro breakouts for precious metals are left. I'll have to dig really hard. Like you could say silver, but silver already, when it went parabolic, it zoomed above.
Right.
And even though it's crashed 40%, it's still
At
in
$80.
breakout territory. Yeah.
Right. Hey, if you had said to me, I said this to someone else the other day. I said, if you had said to me 3 years ago that silver will crash 40%, or let's call it 30%, whatever, 30, 40%, 35%. If you were to say to me 3 years ago, silver will crash 35% and be trading at $80, I would have laughed at you. Laughed. But that's what we have. It crashed 35% and it's trading $80. There's
And I would say,
no other market like that.
think about this and think about what you're saying as far as the next 3 months and then 6 months. If 65 will be conservative, if $65 to $70 silver, if that's the absolute floor over the coming months, then what happens after that to silver stocks? They're going to absolutely crush it.
I hope so. I'm long now. I hope so.
Yeah,
I
me too.
believe it.
Yeah, me too.
No,
Me too.
I know you are. I know you are, but that's new to me. That's new to me. Yeah, I believe that. I believe it's the stock. I believe it's the stock market time. The first move with the commodity is the commodity for guys like me. And then the equities pick up on the second move. And the third move is usually just the commodity again.
Yeah, and just not to name drop, but Rick Rule, that's what he's done in the last couple weeks. He sold, I think he said 80% of his silver on the spike.
He did
And
mention that.
he's putting that capital in silver stocks.
Right. I mean, and that's when people ask, what do I put my money in once I take it out of silver? Put it in silver stocks because they haven't caught up yet. If you're bullish on silver, now's the time to buy silver stocks. At least that's an opinion of mine. But
And the fundamental reason is if $65 or $70 silver, if that's the floor, these stocks are going to do incredibly well.
well, how are they rated right now? Are they rated for $30, $40 silver?
It's a very good question. I have to do a little digging on that, but my sense is $50 silver, maybe
heard
even
lower.
$45 to $50 silver.
I actually heard lower, but I guess it may depend on the. I mean, there aren't a lot of pure silver plays out there. So how do you rate them? There's really not a lot.
It's really hard. It's really hard. And some of the best ones, they're going to get picked off.
Right.
So, but I think Rick Rule, he may have said $40 that they're rated on, or maybe even
I believe
something a
that.
bit lower.
I
But
believe
yeah,
that.
that to me is the real opportunity in silver stocks if 65 to 70 becomes a floor.
Yeah. Well, I want to leave you with one thing about gold. And I talked to someone else about this, but I won't name drop right now. Last quarter for gold miners, this will make you feel good, right? Last quarter for gold miners was probably one of the best they've ever had because they sold so much above the average. This quarter, knocking on wood, as long as gold doesn't crap out, the whole quarter is going to be above 5,000. If the whole quarter is above 5,000, then you're going to have a second quarter in a row of outperformance based on the price of gold. And then people are going to look at miners and go, oh, geez, I guess I should own miners now. So the rule of thumb is the first time you have an outperformance, it's an aberration. The second time you have a trend. The third time it's getting away from you. So I think between now and March 31st, unless gold craps out below 4,500, I think we're going to have an average of over 5,000 for the whole quarter, for whole of Q1 2026. The price of gold will have averaged over 5,000, and their sales will all be over 5,000. Like you can't mess it up. I mean, you can always mess it up, right? But knock on wood, you can't mess it up. The price of gold is over 5,000. What do they have? An all-in sustaining cost of, depending on who you talk to, 1,600, 2,000. I look at it as 2,000. A lot of people look at it like 1,600. I look at it as 2,000. So that's where I am.
Yeah, 1,500 is now, you're a low cost producer now if your AISC is 1,500.
Yeah.
You're in the
Well,
lowest quartile.
yeah, that's the Newmont and Barrick types, depending on what part of their operation you're looking at, I guess. But I'm looking at it like 2,000, 2,100. But yeah, I'm ready.
But
I'm ready for the next leg.
and that's why I have done so little trimming is that based on our analysis, 4,200, 4,300, that could be the floor for gold. That doesn't change much for these stocks. You said that they had a record quarter. What was the average gold price of the last quarter?
I don't know, but they were,
4,640. I haven't looked it up, but it probably wasn't 5,000. It was 4,700, probably something
could have been
in
5,000.
that
It wasn't.
area.
Yeah, it wasn't. It was definitely under 4,700. So yeah, I mean, I remember it was something like Some of the miners were selling, I think, Sol metal at 30% over the average. I'm not sure who that was, but someone did that.
Yeah, I'd have to. Yeah, I'm pulling it up here. I can guesstimate what it would be. Just give me a couple seconds here.
While you're pulling up a daily chart.
I am looking at. Okay, I'm guessing what the average would be for the fourth quarter. You know, the average for the fourth quarter, that actually isn't that high. We're talking about like 4,100.
Right.
200.
That's why I said that.
Yeah.
Like 30% is a high number, but someone had said to me, the average in the fourth quarter, people were selling it at 5,100, 5,200, you know, or 5,000. So that's like, you know, that's like 20%, almost 20%
I see what you're
above
saying, right?
above the average. That's big.
But my point is the average of the fourth quarter. That's basically right now we're looking at a floor.
Right.
For
right. The fourth. Right. Well, that's funny you say that because JP Morgan just did a report that I share with subscribers where they said they're now looking at their basis for the price of gold at 4,500. They're rating their miners at 4,500, whereas everyone else is rating them at 35 or 4,000. So, you know, they like what they say. They've definitely changed their tone towards miners.
My point is, this is why it's been so hard to trim, at least from my point of view, because you look at when the market got really overbought, as it is here and now, and you look and say, okay, well, gold could go down to 4,200, 4,300. How is that going to change the fundamentals of these producers? Yeah, the stocks go down another 15%.
Right.
And that's like the absolute floor. I mean, do you really want to sell out at that point? Or even,
Right.
you know, even trim and take a little bit off the table? It's really hard.
It's like you need gold at 4,200 and oil at $150.
Yeah.
Let's hope that doesn't happen. But yeah,
and last thing, Professor, maybe I'll throw up a chart. We could talk about this in our next podcast, but you've probably seen some of the numbers about the allocations in this sector. We've had an incredible 24 months and people still barely own gold. There was a guy who tweeted, he was at a CFA thing with 500 people and he asked everybody, he gave a presentation. He asked everybody, how many people own gold? I think it was out of 500 people. Can you guess how many it was out of 500 who owned gold in their portfolio? CFAs?
35.
3.
Shut up. Really?
3 out of 500 people.
I was going with 6%.
Yeah,
Holy
you're a 10.
shit.
Divide that by 10.
Wow.
So when you see these statistics, it's actually scary how much higher gold could go. It's scary how early we still are, considering we've had an incredible 24 months.
Or how late everyone else is. They're all still married to the tech stock thing. And that's going away. That's going away soon. All right, cool. So I'll see you in 20 days.
All right. Yeah. We got to leave it there. Finally, before I let you go, tell everybody how they can subscribe to Gold Fix.
Gold Fix is a newsletter that we put out, multiple newsletters daily. And we do real time, we do almost real time, and we do in-depth analysis for mining reports, commodities reports, and geopolitical events. So I would say sign up for free. If you like what you see, you can sign up for premium. It's VBL Gold Fix. We're in the top 30 on Substack, which is an accomplishment I've been told by my friends. So yeah, Gold Fix, GOLDFIX.
All right. Congratulations on being top 30, Vince. Well deserved. Everybody, if you want to follow the gold market on a day-by-day basis, or even shorter term than that, you want to know everything that's going on, all the players, who's buying, who's selling, at what price levels, you got to subscribe to Gold Fix. Vince, thanks so much for coming on. As always, enjoyed it. And I'll talk to you again in another 3 weeks.
It could be a big one. It could be a big one. I'll see you in 3 weeks.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.